Hello everyone, welcome again to the channel of You Will Classes. So today we are in the fourth live session of Amalgamation. In the last three sessions we already covered with accounting in the books of transferor companies. We solved one question where we made all the journal entries, passed all the journal entries and also made ledger accounts in the books of transferor companies, X Limited. And then in the last session yesterday, I took up with the questions on purchase consideration. Those are very important questions from exam point of view. Compulsory question in question 1. Now today we'll go one step further and understand how to do the accounting in the books of transferee. Transferee means which company? Buying company. Okay, so today's session we are going to understand how to do the accounting in the books of transferee company. Again, all of you take out pen and paper, write it along with me to get the maximum benefit from this session. So before we proceed with accounting in the books of transferee company, first we will have to understand one difference between merger and purchase. Okay, we'll have to understand that difference. So all of you first understand how to identify in question whether it is a merger or a purchase. Okay, let's first understand this difference between merger and purchase, because accounting will depend on this. If it is merger, we have to follow a different method of accounting. If it is purchase, we have to follow a different method of accounting. Minor differences are there in both the accountings. Values taken are different. So very first, in every question, what you'll have to do is identify whether the question is on merger or purchase if accounting is asked in the books of transferee company. If accounting is asked in the books of transferor companies, then not to worry. In transferor companies books, there is only one method of doing the accounting. The company is going into liquidation. So those 14 entries what we studied, 6 closing entries, then 3 entries receiving the money, 3 paying the money, and then closing realization and equity shareholders. Whether merger or purchase, those accounting in the books of transferor companies remain same only. What is going to change is only in books of transferee company, depending on is it a merger or purchase. First, how will we identify is it a merger or purchase? So understand it. See, in case of merger, okay, in case of merger, all the assets and liabilities will be taken over. Okay, in case of merger, all the assets and liabilities will be taken over. Even if a single asset is not taken over, it is not a merger. So suppose in the balance sheet, we have land and building, plant and machinery, furniture and fixtures. I discussed that example in the first session with you. Furniture is useless, so not taken over. Then it becomes purchase. Even if a single liability is also not taken over, it becomes purchase. So suppose there are creditors and buying company, transferee company doesn't agree to make the payment to those creditors. Those creditors are not taken over. Then again, instead of merger, it becomes purchase. So you just remember this left side merger. Any of the single conditions of merger not fulfilled, it will become purchase. So what is the first condition of merger? All the assets and liabilities, each and every asset and liability of transferor company must be taken over by transferee company. Even if single asset is not taken over, it becomes purchase. Even if single liability is not taken over, it becomes purchase. Second, at book values, all these assets and liabilities of transferor company will be taken by transferee company at book values. Even if a single asset is taken at a different value, for example, A Limited, B Limited merged into AB Limited. A Limited has land and building of rupees 1 crore. Okay, but it purchased at 1 crore. So in the books it is at 1 crore. You already know how the value of land appreciates over a period of time. So when the merger is taking place, if the value of that land and building from 1 crores has become 4 crores and the transferee company takes it at 4 crore rupees, then it is no more a merger, then it becomes purchase. If transferee company takes at 1 crore only, then it is merger. So second condition is all the assets and liabilities which are taken over, they have to be taken over at which values? Book values. Values appearing in the balance sheet. Different value, agreed value, then it will not be a merger, it will be a purchase. And third condition, payment must be made to equity shareholders. Okay, payment must be made to equity shareholders in the form of equity shares only. Whatever payment we make to equity shareholders must be made in the form of equity shares only. If we give cash to equity shareholders, it will become purchase. If we give preference shares to equity shareholders, it will become purchase. We can give preference shares to preference shareholders, but equity shareholders must be given only equity shares. Now, students, sometimes situations arise where when you calculate that ratio we did yesterday, purchase consideration, for every 2 shares 3 are issued, for every 3 shares 4 are issued. Sometimes some equity shareholders get shares in fractions. So suppose, let us say, for every 4 share 3 are issued. Now if you are having 100 shares, okay, for 4 shares 3 are issued, see here. So for 100 shares, how many will be issued? Now this 100 into 3 by 4 is perfect answer 75, right? 100 into 3 by 4 is perfect answer 75. But if I reverse it, for every 3 shares 4 are issued, for 100 how many will be issued? Now if you do 100 into 4, 400 divide by 3, you'll get maybe 133.33, something like this. So when you get such fractional number of shares, then the fractional amount 0.33 shares value can be paid in cash. If that fractional shares value you pay in cash, it will remain merger only. Okay, if that fractional amount value you pay in cash, it will remain merger only. So here there is an exception. Here there is an exception. What is the exception over here? Fractional amount may be paid in cash. This is an exception over here. Otherwise, the payment to equity shareholders must be made in the form of equity shares only. Okay. So this is how we identify merger in a question. Now, any of the single conditions out of the 3 conditions not satisfied, any of the single conditions out of these 3 conditions not satisfied, it becomes purchase. Any single condition not satisfied, it will become purchase. So you just have to remember, for example, if these liabilities and assets, if any particular asset or any particular liability is not taken over, then it will become purchase. At book value, like I said to you, any asset, let us say plant and machinery or that land and building, 1 crore, 4 crores. If any asset or liability is taken at a different value, it will become purchase. And if you make payment to equity shareholders either in cash or in the form of preference shares, then again it will become purchase. So any one condition of merger also not satisfied, then it becomes amalgamation in the nature of purchase. Okay. So I hope everyone is clear with this, how to identify is it a merger or a purchase. Every question, friends, you'll have to do this. First, you'll have to identify is it a merger or purchase. Why? Because method of accounting to be followed. If it is a merger, then we have to follow pooling of interest method of accounting. Okay, if it is a merger, then we have to follow pooling of interest method of accounting. Vice versa, if it is purchase, amalgamation in the nature of purchase, then we need to follow purchase method of accounting. And journal entries in both the methods are different. So it will be very important to first identify in the question, is it amalgamation in the nature of merger or purchase? Why? Because if it is merger, okay, if it is merger, then you will follow pooling of interest method of accounting. And if it is purchase, then you will follow purchase method of accounting. Now I will teach you in the today's session what journal entries are to be passed in the books of transferee company by pooling of interest method and by purchase method of accounting. So all of you can make the format in vice versa column only, difference kind of column only. So you understand the difference in method of accounting in pooling of interest as well as in purchase. So what you all can do is just make a bifurcation over here itself so that you understand how to pass the entries if it is pooling of interest method and how to pass the entries if it is purchase method. So let us take up with the accounting. Left side we take up with pooling of interest method and right side we take up with purchase method of accounting. Now, total maximum 6 or 7 entries are possible, out of which 3 entries will be there in all the questions. First 3 entries will be there in all the questions, whether it is merger or is it purchase. So whether you follow pooling of interest method or you follow purchase method, minimum 3 entries in the books of transferee company you have to pass in each and every question. After that, remaining 3 to 4 entries, 4, 5, 6, 7 entries are to be passed based on question to question. If that information is given in the question, then only you have to pass those entries. So what are those entries in the books of transferee company? Now see, think it logically. Transferee company means buying company. Company is purchasing the other company. So what entries will a purchasing company pass in its books of accounts? Very first entry what purchasing company will pass in its books of accounts will be for purchase of business. Okay, in comparison form, we will see what entries should be passed in pooling of interest method and if it is purchase method. So first you will identify in the question, is it merger or purchase? All assets and liabilities taken over at book value and equity shareholders given only equity shares. All conditions satisfied, merger. Merger means pooling of interest method. Any one condition not satisfied, purchase means purchase method of accounting. So first you'll identify in the question, is it merger or purchase? And based on that, you'll pass the journal entries. So in pooling of interest method, the first journal entry is business comes in, debit what comes in. Business purchase account debit. Okay, business comes in, debit what comes in. business purchase account debit. And then whatever amount of purchase consideration is payable, transferee company is supposed to pay that amount to whom? Liquidator of transferor company, and then liquidator will further do the distributions. Liquidator will pay to equity shareholders, preference shareholders, liabilities, everyone. So transferee company is supposed to pay that amount to whom? Who is that intermediary in between? Who will get that amount? Liquidator. So amount is payable to liquidator, credit the payables to liquidator of transferor company account. Okay. So very simple entry. First entry for purchase of business. Business comes in. Debit what comes in. Business purchase account debit. Amount is payable to the liquidator. Credit the payable to liquidator of transferor company account with the amount of purchase consideration. Okay. What amount will you record over here? Purchase consideration. Is that clear to every one of you? Now, this entry will remain same even if it is purchase method of accounting. Okay, this method will remain same even if it is purchase method of accounting. So whether merger or purchase, first entry will remain same. Even if it is purchase method of accounting, first entry will be business purchase account debit to liquidator of transferor company account. Second, for taking over assets and liabilities. Now, when you are buying the business of other company, then you are taking over their assets and liabilities also. So what entries will you pass for taking over the assets and liabilities? Okay, we understand them in comparison. If it is merger, pooling of interest method, then what entry will be passed? If it is purchase method of accounting, then what entry will be passed? Now in both the situation, assets comes in, debit what comes in? Assets account debit. Liabilities of transferor company become the liabilities of transferee company. So liabilities become payable. Credit the payables to liabilities account. And business purchase account, this account over here will get closed. Okay, this account will get closed. So you'll reverse and credit to business purchase account. This is the basic entry to be passed. Whether is it pooling of interest method or it is purchase method of accounting. In both the cases, this entry will remain same only. Assets comes in, debit what comes in? Assets account debit. Liabilities are payable, credit the payables to liabilities account, and purchase consideration we will credit business purchase account which was debited in the first entry to close it. That amount, that business purchase account gets closed because now assets and liabilities have been taken over. Okay. Now the difference what will be? Here also the entry will remain same. Assets account debit to liabilities account to business purchase account. So entry in both the situations will remain same only. However, here these both will be recorded with book values. This is important, okay? Here these both will be recorded with which values? Book values. Because we are doing which method of accounting? Pooling of interest method. When do we follow pooling of interest method of accounting? When assets and liabilities are taken over at book values. So in this first method, pooling of interest method, assets will also be recorded at book value, liabilities will also be recorded at book value. Whereas in case of this method, they will be recorded at agreed values if given in the question. If not given, then obviously book value, but otherwise they will be recorded at agreed values. So if it is given that land and building of 1 crore taken at 4 crores, then it will not be a merger, it will be a purchase. And in case of purchase, then which method of accounting will be followed? Purchase method of accounting. So in purchase method of accounting, that land and building will be taken at 4 crores. In pooling of interest method, that land and building will be taken at 1 crore itself. This is the first difference. Second difference. Okay, second difference. This liabilities over here. This liabilities over here will include liabilities over here will include reserves and surplus. All the kind of reserves and surplus also in this, if it is pooling of interest method. So A limited, B limited forming AB limited. If A limited has general reserve, B limited has profit and loss accounts credit balance, A limited has security premium, B limited has capital reserve, all the four will be shown in the books of AB limited. So in that liabilities, we will include to general reserve also, to security premium account also, to profit and loss account also, and to capital reserve account also. So liabilities in this credit entry will be including reserves and surplus in the books of transferee company if it is pooling of interest method. However, if it is purchase method, then it will not include those reserves and surplus. So this is an important difference. Every one of you must notice this. Okay, that if it is purchase method of accounting, then all those four things, general reserve, profit and loss account, security premium account, capital reserve, will not be recorded in purchase method of accounting, except that other liabilities, debentures, external liabilities, debentures, creditors, bank loan, those will be taken into consideration. Okay, so first entry I told you is exactly same. Second entry in principle is same, asset to liability to business purchase, but there are conceptual differences. In pooling of interest method, assets and liabilities are to be taken at book value. In purchase method, they are to be taken at agreed values. In pooling of interest method, liabilities will include reserves and surplus also. In purchase method, liabilities will not include reserves and surplus. Third difference. Okay, third difference in this second entry itself. Second entry is very important in the books of transferee company. Third difference is that any difference or balancing amount, in the journal entry, particularly you can say difference between share capital minus purchase consideration. Whatever is the difference between share capital minus purchase consideration will be adjusted with the amount of reserves and surplus. Any difference amount between share capital and purchase consideration. So let us say that A limited share capital 50 lakhs, B limited share capital 40 lakhs, 90 lakhs. Total purchase consideration payable to both is 80 lakhs. So 10 lakhs here is a profit that will credit to P&L account. But if against 90 lakhs you pay 1 crore 10 lakhs, 20 lakhs of loss, then that 20 lakhs of loss you adjust from those companies' reserves only. So if there is a general reserve of 30 lakh, you adjust 20 lakh of loss, and in the journal entry you record general reserve only with remaining balance of 10 lakhs. Okay. See, tomorrow's session I will be solving one question where we'll have pooling of interest method, and one more question I'll solve in tomorrow's session where we'll have purchase method of accounting. So this difference will again become clear in tomorrow's session. But this is an important difference, that in case of pooling of interest, share capital minus purchase considerations difference amount is to be adjusted with those reserves and surplus only, and balance reserves will only be credited in the journal entry. Whereas here, any difference amount or balance amount, which difference or balance? Net assets minus purchase consideration, not share capital. There's again a difference, note it down. Here we compare share capital with purchase consideration. Here we compare net assets with purchase consideration. What is this? NA, net assets. Any difference between net assets and purchase consideration will be either debited to goodwill account, either debited to goodwill account, or credited to capital reserve account. Means, let us say assets minus liabilities 90 lakhs, same like share capital. Suppose against 90 lakhs, if you're paying 80 lakhs, you're having capital profit of 10 lakhs, you're paying less. So 10 lakhs you will credit to capital reserve account. And against 90 lakhs, if you're paying 1 crore 10 lakhs, then 20 lakhs extra you're paying for the reputation of those companies. So that amount you will debit to goodwill account. So this difference you'll find over here. In this entry, you have to compare share capital with purchase consideration. In purchase method, you have to compare net assets with purchase consideration. Here, the difference amount is to be adjusted with reserves and surplus. Here, if purchase consideration paid is more, then you debit goodwill account. If purchase consideration paid is less, you credit capital reserve account. Okay. So this is the second entry to be passed in the books of transferee company. Now, third entry. Payment to be made to the liquidator now. Okay, assets are taken over, liabilities are taken over. Now here we discussed that payments will be made to whom? Payment will be made to the liquidator of transferor company. So now we'll pass the entry for making payment to the liquidator. So for payment of purchase consideration, okay, we have to pay the amount of purchase consideration. Now here again, in principle, the entry will remain same in both the books. But as per the concepts we discussed, that here the payment is to be made to equity shareholders in the form of equity shares only. So in pooling of interest method, what payment we will be making to the liquidator will include only one thing, that is equity shares. So entry will be liquidator is the receiver, debit the receiver, liquidator of transferor company account debit. Okay, liquidator is the receiver, debit the receiver, liquidator of transferor company account debit. And you are going to give only one thing, that is equity shares. So to equity share capital account. And we discussed preference shares may be given to preference shareholders. So if preference shareholders are there, then you can also have two preference share capital account. However, over here, if we see purchase method of accounting, then you can pay equity shares also, and preference shares also may be given to equity shareholders, and cash may also be given. Debentures may also be given. I told you in the first session that as far as you are paying debentures, not to debenture holders, to shareholders, it will be included in purchase consideration. So here this minor difference will come. Liquidator is the receiver, debit the receiver, liquidator of transferor company account debit. But what will you be giving them? If you give equity shares, then to equity share capital account. If you give them preference shares, then to preference share capital account. And if you give them cash, then to cash or bank account. If you give them preference shares, preference share capital account, If you give them cash, then to cash or bank account. Okay, sorry. So conceptual differences there in merger and purchase. Based on that, this entry will differ. Okay, if you give them equity shares, on the right side I'm talking about purchase method. Equity share capital account if you give them preference shares, preference share capital account if you give them cash, cash or bank account. Now these three are compulsory entries. Every question will have these three entries. Each and every question will have these three entries. First entry, purchase of business. Second entry, taking over assets and liabilities. Third entry, payment of purchase consideration. These three entries will be passed in each and every question. Remaining entries, what we see below this, they are not compulsorily there in every question. If information is given, then only we have to pass those entries, otherwise we don't have to pass. So what are those entries? Okay, let's see. Fourth, for issue of shares, fresh issue of shares in the public. Now it is possible that A Limited, B Limited merge and form AB Limited. It is possible that AB Limited is in need of more money, and one of the conditions of merger, which we did not discuss in the three conditions above, additional condition, not from accounting point of view, is that 90% of equity shareholders of transferor company must be there in transferee company. Still you have scope of recovering money from public, outside people, 10%. So it is quite possible that some shares might be issued in public. If you issue the shares in public, then normal entry, what we have been studying earlier, two entries will come. Bank is the receiver, debit the receiver, bank account debit, and temporarily we transfer the money to share application and allotment account. In second year you must have studied this entry. And second entry, share application and allotment account debit. Okay, I'm talking about full lump sum money, entire 10 rupees called in one go. Then share application and allotment account debit to share capital account. Okay, and if they are issued at premium, to security premium account. And that you can have in third entry also. If shares or preference shares are issued at premium, then to security premium account will be credited even in this particular entry. Okay. Now this entry will remain same in both the cases, whether it is merger or it is purchase. Okay, in any of the situations, this entry will remain same. If you issue shares in the public, then bank account debit to share application and allotment account, share application and allotment account debit to share capital account. Now fifth entry, okay, expenses on amalgamation. Okay, we had that point in the first lecture also, that if expenses are paid by transferor company, you record the entry in the books of transferor company. And if expenses are paid by transferee company, you pass the entry in the books of transferee company. So over here, for any of the amalgamation or liquidation expenses, which liquidation expenses? Transferor company. Though they are liquidation expenses of transferor company, transferee company may pay it, because if it is merger, then A Limited gives its cash also to AB Limited, B Limited gives its cash also to AB Limited. How will A and B Limited pay for its own expenses? Here transferee company AB Limited will pay for liquidation expenses of A Limited as well as of B Limited. So for amalgamation or liquidation expenses, now this entry is again different in both the situations. Okay, in case of pooling of interest method, means merger, in case of merger or pooling of interest method, this expenses we will recover from reserves or profit and loss account debit. And cash goes out, credit what goes out to cash or bank account. Okay, all these expenses we will adjust and recover from reserves or profit and loss account. So reserves or profit and loss account debit, and cash goes out, credit what goes out to cash or bank account. And here the entry will change. If it is purchase method of accounting, then see, over here in second entry you all can see that this amount was adjusted with reserves and surplus, and this amount was adjusted with goodwill or capital reserve. This is the difference, because here we adjusted with reserves and surplus, we debit reserves and surplus account or profit and loss account. But because here it is adjusted with goodwill or capital reserve, this same account will be debited over here depending on second entry. If in second entry there is goodwill, then you debit goodwill account, and if second entry there is capital reserve, then you debit capital reserve account. So either goodwill or capital reserve account debit, and again cash goes out, credit what goes out to cash or bank account. Okay, goodwill or capital reserve account debit to cash or bank. So I hope everyone is clear with this difference, why it will come here. So because here the difference was adjusted with goodwill or capital reserve, so here you will debit goodwill or capital reserve. Basically, why would you pay, transferee company pay for liquidation expenses of transferor company? For its reputation. One reason is I told you they are cashless. New company is going to take over their cash. So that's why that amount we adjust against the goodwill or capital reserve. Okay. Going further, now these all are extra entries. All these entries 4, 5 are to be passed only if that information is given in the question. 3 entries you have to pass compulsory. 4th, 5th onwards you have to pass only if those specific information is given in the question. Otherwise you don't have to pass those entries. Okay. So 6th entry. Now payment of liabilities. If now if any liability we discussed was not taken over by transferor company, transferee company, then they would be paid by transferor company itself. But if all the liabilities are taken over, then it might be possible. See, generally you will find this entry in case of debentures. Okay, generally you will find this entry in case of debentures that A Limited's debentures may object and they may not allow the amalgamation. In some cases, you have to take the consent of creditors, money lenders also while making an amalgamation or forming a merger. Debentures of A Limited may say that we are getting 10% interest. We are ready for this merger only if in new company you pay us 11% interest. Now, just because of that 1% rate of interest, maybe this merger might not take place and some legal problems may arise in having a merger. So AB Limited may agree, okay, in the new company we will pay you 11% interest, only 2 more years are remaining. So after 2 years that liability will be over. So generally this 6th entry you'll find in case of debentures only. You'll find in case of debentures, old debentures are given new debentures. So what you'll find generally in payment of liabilities is, now this entry will again remain same in both the cases. Liabilities are the receiver, debit the receiver, liabilities account, debit. And whatever you give them, cash, debentures, in some cases you give them equity shares also, so equity share capital, whatever you give them you'll credit that. And in both the cases, whether pooling of interest method or purchase method of accounting, this entry will remain same. And you remember, generally this entry will be what? Debenture to debenture. Sounds funny, but debenture to debenture means maybe 10% debentures to 11% debentures. So it's not exactly the same ledger account. Or maybe 10% debentures to 12% debentures. So in that situation, old 10% debentures account will be closed and new 12% debentures account will be created in our books. Okay, so generally you'll find this entry in case of debentures. And lastly, last entry, again as I said, all these entries will be there 4, 5, 6, 7 only if specific information is given in the question. So for preliminary expenses, what are preliminary expenses? See, new company is formed, AB Limited. So AB Limited will have to get its registration done with Registrar of Companies. AB Limited will have to list their shares in the stock exchange. So even new company will have some expenses immediately after amalgamation. Those expenses AB Limited has to record in its own books of accounts. So what will that entry be? Whatever expenses you are incurring, debit all expenses and losses. Preliminary expenses account debit. And generally you would pay those expenses in cash. So cash goes out, credit what goes out to cash or bank account. And this entry will again remain same, whether it is pooling of interest method or purchase method of accounting. This entry will again remain same. Okay, so 1, 2, 3 entries are going to be there in all the questions. 4, 5, 6, 7 will be there only if specific information is given in the question. Important are which entries? Important is entry number 2 because that entry is different in case of pooling of interest method and purchase method. It has many differences. And important is entry number 5 because again for liquidation expenses the entry is different in books of in pooling of interest method and in purchase method. Other entries are more or less same, whether it is merger, that is pooling of interest method, or it is purchase method of accounting. So you all try to learn these entries by heart. Try to write them again without seeing so that you understand the difference between the two. Tomorrow will be the last live session of amalgamation. Okay, in tomorrow's session we'll be taking up with a question where we will apply pooling of interest method, and one more question, 2 questions I'll be solving in tomorrow's session where we will apply purchase method of accounting, and we'll also learn how to make balance sheet in those books. If you have missed out on any of the sessions, you can refer to the last 4 sessions. The videos are already there in our channel. Do subscribe to our channel, press the bell icon to get the notifications of such live sessions in future. And students, just these 5 sessions, last 4 including today and one more tomorrow, will make you aware about all the accounting of amalgamation. So from exam point of view, devoting around 5 hours and watching 5 sessions of amalgamation will make you clear with the entire chapter of amalgamation. So it's a crash course revision from our side. We have tried to give you the best in the shortest time which is possible. Okay, 5 hours of study in the coming days and you'll be prepared with chapter of amalgamation from exam point of view. So I'll sign off for today. I'll see you again tomorrow. Timings etc. are a little bit flexible, so you stay tuned to our channel. You'll come to know at what time we'll come live tomorrow. Bye everyone. Take care. Happy studying. Bye.